So today I want to talk about my 12-step acquisition framework after buying and selling well over $100 million in online companies. I think that there is more than just buying a company and operating the company. And so that's why step one is going to start with an overview of the acquisition basics. There are advantages of buying a company versus starting a company. And that is because when you start a company currently in the United States, there's about a 65 to 90% failure rate in the first 5 years when you start a company, and that varies depending on what type of business you start, where it is, etc. But when you are acquiring a company, the failure rate is much, much lower than that, and you can see evidence of this by looking at the write-off rate for SBA loans. So the SBA loan program is a loan program we have in the United States to acquire companies and small businesses from about $500,000 to $5 million, and they publish the rate at which these companies essentially default on their loans. And they're typically single digits. So buying a company is a much safer bet than starting a company because you're already buying a product or service that's been proven to work in the marketplace. You're already buying a set of systems, a team of people, a history of marketing, product market fit and branding and all these different things that are essentially just handed over to you. So then the most important part, I think, the biggest benefit of buying an existing company is that you're already making money from day one. With a 65 to 90% failure rate, you are likely never going to make a profit. And if you do, you may not make a profit for the first few months or the first year or maybe the first couple of years. So the ability to find a company that already works and has everything already included in it and that makes money from day one is a huge advantage, in my opinion, over starting a company from scratch. In addition to that, I think that buying an online company is something that you can operate from the comfort of your own home, or you can operate from Airbnbs or hotels if you like to travel, which I do. Me and my family like to travel a lot. So I think that being able to have a company that not only you can operate from home or anywhere in the world, you can also scale much larger, much faster, much easier than you can conventional brick and mortar businesses. So as an example, if you're buying a laundromat, that laundromat serves people typically within a couple of miles of its location. And if you want to expand and grow your laundromat, you have to go find another location. It could be, 5 miles down the road, in another city, in other states. And there's a lot of work that goes into that process. Whereas if you own a digital marketing agency or you own an e-commerce company or Amazon, you can sell to more people than just the surrounding 2 5-mile radius. You can sell to people in the entire state, in the entire country, and of course in the entire world, often with just a few clicks of a button. It's very easy to expand. So just having an understanding of why you want to buy a company versus start a company, what the advantages are to buying an online company versus a brick and mortar company is an important part of the process. So that's step one here. And then step two is understanding how to value companies, right? So I was a commercial real estate appraiser in my past life. And so I like to use real estate as an example because a lot of people understand how real estate is valued. It's a much easier process than valuing a company because in real estate, all of the sales transactions in the United States and in many other countries are all public record. So a realtor can go into a neighborhood, they can pull up the previous sales that occurred in that neighborhood over the past 3 to 6 months. They can eliminate the houses that are wildly different and have a nice group of comparables to look at and compare to the home they're trying to sell and say, these 3 homes sold within $300,000 to $350,000 over the past 6 months, and make some minor adjustments and have some very reliable evidence as to what the market value of that home should be. However, when you're valuing digital companies, there's not as much data out there. These transactions are not public records. So what other similar companies sold for in the past are not going to be easy for you to find and discover. So you kind of have to look at what's currently listed on the market and understand that sellers and brokers will list the company a little bit above what they think they can sell it for. And so you just have to adjust some of that based on, what's in the market today. And brokers do that based on their experience, what similar companies they have sold in the past year or two and make, adjustments for those current listing up or down. So typically when you're buying a small business in that, $500,000 to $25-50 million range, they're sold on a multiple of the profits. And for online businesses, the profits are typically looked at as using the EBITDA number. So the earnings before interest, depreciation, and amortization. And if you're familiar with EBITDA, you might know that Warren Buffett and Charlie Munger sort of popularized that EBITDA is a BS number because companies actually have depreciation and amortization. But in online companies, there aren't any hard assets to depreciate. So EBITDA is actually a pretty reliable number for profits. Another term you might see is SDE, which stands for seller discretionary earnings. And seller discretionary earnings are basically taking EBITDA and adding back any personal expenses that are run through the business that the owner is claiming as an expense just to reduce their tax burden to the IRS or their other tax agencies. So as an example, if the company is claiming that it has, $500,000 in EBITDA, but the owner ran his Porsche expense through the company, that was $100,000 expense that year, you can take that $100,000 and add it back to the profit, back to the EBITDA. So you take the $500,000 in EBITDA plus the $100,000 in Porsche expense, and the company really made $600,000. And that's reasonable because Porsche did not drive revenue for that business as long as the owner wasn't taking clients out in the Porsche for joyrides or something like that, or on the racetrack. That's kind of how valuations work. So you take the EBITDA or the SDE of the company and you multiply it by a multiplier. And that multiplier is also based on what other similar businesses have sold for in the recent, marketplace. So typically online businesses that are $500,000 to $5 million, $10 million valuation range are going to have multiples about, 2.5 to 3, all the way up to maybe about 5 or so, depending on the type of company. It could be higher for software, SaaS, or high recurring revenue companies. So you would take, in that example, the $600,000 in SDE, call it a 3 multiplier, and 6 times 3, is $1.8 million valuation. So that's how you value businesses. And your job as a buyer is just to understand what the current market multipliers are and how to evaluate that add backs you see on a P&L. You have to understand that is the seller or broker including add backs that are not real legitimate add backs? Are they trying to include maybe some marketing expenses that they experimented with some new marketing over the past year and they're trying to add back that expense to the profits and call that, a valid add back to increase SDE? In my opinion, that's not a valid add back because every company experiments with marketing and you're always going to have some amount of marketing expense that does not work. A Porsche that he is just using for personal uses is a valid add back. A marketing expenses would not be a valid add back in my opinion. So that's step 2 in my roadmap to buying an online business. So step 3 would be understanding what type of business to acquire. This includes performing a self-assessment, understanding business model alignment, and whether or not you want to take an investor or operator role. So self-assessment, it's always great to understand what your personality is, your skill sets, your experience, and then your overall goals in buying a company, right? So if you're tech savvy, maybe something in the software space would be a better acquisition for you. If you love the idea of having physical product, then maybe an e-commerce or Amazon company would be more ideal for you. If you are a people person, you love helping people, maybe an agency model or a consulting company is a better acquisition for you. And then, of course, you have to layer in your experience, which you're good at. Ideally, you can find a business that is lacking some sort of skill set that you bring to the table, and you can essentially buy that business for a deal because you can come in, add your skill set and expertise to that company and start to grow the company immediately from day one. So just a few things to think about when you're looking to acquire a business. And then, of course, do you want to take an investor or operator role? A pretty common opinion that buyers of companies don't want to buy a job, but that's not always true. Some people want to buy a job. They don't, they love having something to do every day. They don't have a lot of hobbies or anything like that. They love what they do and they want to buy a company where they can come in and operate and manage the company. Not everybody is buying a company as an investment. So, I don't see that as a deal breaker. If you want to come in and buy a company and spend, 20, 30, 40 hours a week in that company, operating it and working with people and doing that thing that you enjoy, that's great. More power to you, in my opinion. So, but you have to decide, right? If you want to buy a company as an investment, more of a passive investment, and not work in the business for 40 or 50 hours a week, you have to make sure that that company is set up to run that way. So that's the last thing I'll say on step 3. Step 4 is how to be a successful buyer. This is a very common issue with new buyers because, especially new buyers with money, they think that just because you have the funds to acquire a company, that the seller is going to sell you their company. And that's just not true. In my experience, well, I'll say that selling a company or buying a company is not like buying or selling a used couch or a used dresser or a used car where there is no emotional attachment to it. Companies, most of the time, have actual humans working in the company, and a business owner could have spent the last 5, 10, 20, 40 years building that company, and it has a lot of sentiment and emotional attachment to him or her. They might have family members that work in the company, and if not, the employees may feel like family members to him because they might have worked with him for a decade or 20 years. I've sold companies that have been handed down to 2 or 3 generations. So there's a lot of emotional attachment to these companies. And to be a successful buyer, you really need to have perspective from the seller's viewpoint and understand that this business means a lot to him. The people mean a lot to him. The reputation means a lot to him or her. And you have to really come across and, set a good example and build a great relationship with that seller. On top of having the financial capital or lending ability to, acquire that company financially. So I would say that you really need to set a good meet, make a good impression with the seller, get to know them on a personal basis, show them that you have the financial ability, show them that you have the operational ability to run the company and that you're going to take care of their company and the reputation and employees. So that's really important. I've seen many sellers select a lower offer because they liked the buyer better, or they had more confidence in that buyer could take care of the company and grow it into the future. Step 5 is financing your acquisition. So, like we just mentioned, you have to have the financial ability to buy a company, and coming to a company without any financial preparation is, just setting yourself up for failure. Just like when you go to buy a home, you typically will go get pre-qualified to understand how much home you can buy. You want to do the same thing when you're looking to buy a company. So like I mentioned, in the US, we have a great program called the SBA loan program where you can basically buy a US based company as long as it's a stable company and not in some expensive industry. You can buy a company with as little as 5 to 10% down. So you want to go to a lender that actually closes on deals in the online space. Most SBA lenders in the country will not finance an e-commerce company or a software company because there are no hard assets attached to the business. So you want to find a lender that will lend on the type of company you want to buy. Speak to that lender, see if they'll give you a pre-qualification letter saying, hey, John, I've reviewed John's financials and experience and tax returns and work, history, and we will underwrite John for up to a $4 million loan to buy a company. And when you're going to look at companies, you present this letter as well as like a nice one-pager, like a sort of like a short resume cover, a one-pager about you and your relevant experience, the pre-qualification letter, and that will get your foot in the door with any seller, any broker for any companies around that $4 million or less mark. You can't take a $4 million pre-qual letter and start looking at $10 million companies because you have no evidence or that you can actually close on a $10 million company. So that's something that sellers and brokers look at. So prepare those documents and get pre-qualified for an acquisition if you can. If you're not using an SBA loan, try to get some sort of commitment letter from your private lender or friends and family, things like that. And then step 6 would be sourcing deals. So there's various ways to source deals. There's for sale by owner listings, there's broker listings, there's off-market deals, and you just want to understand the process and optimize that process for whichever type of company you're looking for. So for sale by owners are going to be on marketplaces such as BizBuySell is the largest in the world right now. You can buy companies that are for sale by owner on Flippa, and there's probably a few more out there, maybe acquire.com, probably, even like Craigslist or something like that. There's probably some random ones. Then there's broker listings, of course. Companies like Latona, QuietLight, Website Closers, Flippa does some brokering as well. There's a million of these brokerages out there you can find online companies. So you just have to go to those sites, put in a filter, and save some custom searches, things like that. There's a site that aggregates all of these listings for you. If you go to, I believe it's withkumo.com, Kumo, they have basically a platform that scrapes all of the broker sites, and you can look at listings on one easy to review platform. And then of course is off-market deals. If you want less competition when you're buying a company, you don't want to compete with other buyers submitting LOIs and offers, then you should go out and reach out to sellers directly. It's much more time consuming, much more complicated, but you could potentially get better deals and you could potentially find companies with no competition. Now I say potentially get better deals because in my experience, most sellers think their companies are worth a lot more than they actually are. So there definitely involves some education when you're speaking to sellers about, actual market values of their company. Every seller wants to get some strategic value for their company. They want to find that perfect buyer who can pay more than the market for their company. But as a buyer, that's just not your position most of the time. So it's a great way to find companies, but you have to take the time to reach out to them through social media or email or cold email, phone calls, some manner to find these listings. Step 7 is going to be preliminary assessment. So when you find a company that's of interest to you, you're looking through all of these listings on platforms, you're talking to sellers, you need to understand how to quickly review that company to understand if it's worth your time to submit an offer and then go through and spend a lot of time and potentially money in the due diligence process. So you want to make sure that you have a clear set of requirements that you're looking for in an acquisition. Make sure that the revenue is at least stable, if not growing, that there's no, random dips in revenue from month to month, that it's not crazy seasonal, unless you want some crazy seasonal business, of course. But ideally, it has a pretty standard, reliable month-to-month revenue in the P&L, and that the cost of goods are pretty standard and stable, that the expenses are pretty stable from month to month, that expenses don't spike like crazy in one month or another for some strange reason. So, you want to buy a good, steady, stable business that's been around for at least 3 to 5 years, because the longer that business has endured the ups and downs in the economy and environment and marketplace and competition, the more likely it is to continue that profitability into the future. At the end of the day, really the basis of valuation. Will that asset continue to be profitable into the future? So just create a set of checklists that you can use, and I'll go through those in another video, that you can quickly assess companies in 15, 20, 30 minutes tops. And then step 8 would be crafting an offer. So you found a company, you think it's worth your time to dive in deeper and spend some time in due diligence. Crafting an offer is going to be essentially you're telling the seller what you think the company is valued to you, what you're willing to pay for the company, but not only the purchase price, also the deal structure. So most small business deals include some amount of seller financing. And if you're talking to sellers directly, you oftentimes have to sort of educate them in that. SBA loans love to see some seller financing included in the deal, even if it's only 5 or 10%. If you want to buy a company with 5% down, you have to then, the seller has to offer at least 5% seller financing into that deal as well. So the SBA requires that you put a 10% equity injection into the deal. So if you're not putting 10% down, you could have the seller put up to half of that equity injection down right now with the new SBA rules and regulations. So you can put 5% down, the seller can put 5% down via seller note, and you can buy a company with 10% down, but you only put 5 of that 10% down. So it's a great structure. So you want to think about not only the overall value of the company, but the deal structure, how much seller note you want to offer in the LOI. You're going to request 10% seller note, 20% seller note. Is that seller note going to be forgivable? Are you buying a company that's grown really quick over the past few years? If so, it's hard to determine if that company is going to continue to grow at a 50% clip year over year. Obviously, it can't do that forever, because it'd be a multi-billion-dollar company in 7-10 years. But so just think about the value, the deal structure, the seller note. Is a seller note forgivable? Will there be an earnout? Where the earnout or forgivable seller note is going to be attached to? Is it going to be attached to revenue? If the company doesn't hit certain revenue markers, is some of that seller note going to be forgiven over time? If the company doesn't hit certain gross profit markers, is some of that seller note going to be forgiven over time? Or are you going to tie it to the profits of the business, which is sort of a harder negotiation there, because sellers would rather tie it to revenue, buyers would rather tie it to net profits. So there's no expenses that can be thrown in the middle and artificially making the seller note more forgivable than it should be. So just a bunch of things to think about there. I know it's a little bit complicated, but again, I'll go through all the crafting an offer LOI structure in a separate video. Step 9 is due diligence in legal. So now you submitted an offer, you've negotiated an offer, you're both happy with an LOI structure and amount, and it's time to perform due diligence on the company. As a buyer, this is your opportunity to make sure that that company is what the seller is claiming it is. And so there's financial due diligence, there's operational due diligence, there's legal, market analysis. It's a very in-depth process, and it typically takes buyers, depending on the complexity of the company, anywhere from about a month to 3 months to perform a full due diligence. Now, if it's your first time buying a company and first time running through due diligence, I always recommend using an experienced due diligence company. Centurica is a great due diligence company that I've used many times and recommend to people. They will essentially do this entire process for you. Attorneys attorneys can help out with some of the legal due diligence, accountants and things like that. Just make sure that whoever you're selecting as a due diligence partner will present the information to you in a fair light and not just try to find all the reasons why you shouldn't buy that company. Because I've seen, people use their accountants, and the accountant will tell the buyer all the reasons why they shouldn't buy the company, but leave out all the reasons why they should buy the company and all the upsides of that company. And they pass, and we go and sell that company to some other buyer who does a great job with the company and ends up making a ton of money at the end of the day. So just make sure you choose the right due diligence partner and that they have a entrepreneurial perspective to performing due diligence and not just trying to nitpick and find all the reasons why you shouldn't buy the company. Because at the end of the day, think about the incentive structure of your attorney or your accountant. If they advise you to buy a company and something should happen to that company in the future, then it kind of blows back on them. But if they always advise you not to buy a company and you never buy the company, then they never get in trouble. So, analyze the incentive structure, find somebody entrepreneurial minded, a good partner who's done this a lot of times, and use them. And, just make sure you do a great job. So that's financial due diligence. That's due diligence overall, closing and transitioning to business. So now due diligence is checked out. You're going to buy a business. It's sort of similar to when you buy a house. There's a final due diligence is done. There's some paperwork done. If you're using a loan to buy the company, you come to, typically for digital companies, you jump on a Google Meet or a Zoom call and you start transferring the documents, the assets of the company. So if you're using lending, we'll wire the money to either an escrow or directly to the seller if there's attorneys involved. An escrow service is basically a third party that holds the money until the assets are transferred to ensure a safe transfer of the assets. In shady digital company deals, sometimes I've heard of somebody wiring a seller 25 grand or 50 grand for a company, and they're located in Malta or Dubai or something like that, and they didn't really own assets, or they just took off with the money. So you don't want to send your money directly to the seller. You want to send it through an intermediary. It's called an escrow service. They'll charge you a small fee for that, but they hold on to the money and make sure that all the business assets are transferred to you before that money is sent. It's definitely worth the cost. So that's closing and transitioning. Everything signed electronically, then you just bought yourself a company. So that's not the end of the story though, right? Like I said, there's preparation to buying a company, and then there's work to do after you buy the company. So what happens? Now you bought a company, and what the hell do you do with it? Well, I say that when you buy a company, especially for people who are newer to digital companies and newer to online marketing, you want to come in, buy the company, and learn from the team and the owner for the first 6 months and try not to change a thing. Because when I see acquisitions go wrong, it's when the buyer comes in, thinks he knows better than the existing set of operations and team and SOPs, and owner starts changing things, and then revenue starts declining. So remember, you're buying a proven set of systems in marketing history and team and expertise and products and services. Don't come in on day one thinking you know better than this group of people who have built this business over the past 5 or 10 years. So come in, learn as much as you can, right? If you then want to start making changes, 4 months, 5 months, 6 months in, just start changing one thing at a time. That way there's only one variable to analyze, and you know exactly, what caused the changes. So if you change marketing, and the revenue starts declining, you can change that marketing right back to how it was. That didn't work. And so that's really my biggest takeaway from operating and scaling a company. If you're experienced and you want to jump in and start making more changes on day one, great. You're experienced, you have the responsibility, and your expertise, and go ahead and do that. If there's things that are wrong, completely just broken or wrong with the business, and you have some experience as well, just of course go ahead and jump in and change it. But my take home message is that if you don't have a lot of experience and something's not broken, try not to fix it. So and then step 12 would be preparing for an exit. This is really just buying a company in reverse. All those things you looked at when you're buying a company, the pre-assessment, the red flags, the green flags, you want to make sure that you always maintain that into the future, and that your company is prepared to sell at any day, even if you don't want to sell it. So having, professionalized operations, bookkeeper and accounting running professionalized books. I always tell people, if you want a professional value for your company, you have to have professional financials. You think about if you have a service business and you're bringing on, let's say you brought on a large client 1 month, and that client is now 30% of your revenue. Well, my advice is to take at least 50% of the profits from that big client and go expand your clientele. Because when you go to sell, just like when you're going to buy, you don't want any key client risk, any concentration risk on the clientele. You don't want any one person responsible for the entire success of your business business. You don't want any one, that goes for employees, that goes for clients, that goes for, you don't want any one marketplace, any one marketing channel responsible for a big portion of your revenue and success of your business. So make sure that as you're operating the company, you don't start getting any sort of concentration risk or client risk or key person risk or anything like that. Try to stay as diversified as you can and grow the company in a way that is optimized to sell it. Because, having a company that's optimized to sell increases the value of that company exponentially. Buyers take a huge reduction in value if 40% of your revenue comes from one client or one guy's running the whole company. So just think about that as you're operating and scaling your business into the future. And as you can see here, that leads to a pot of gold, ideally a great liquidity exit for you and your family. You can now do whatever you want to do in life outside of running a business, if that's what you want to do, or use your business assets to go acquire another business, continue the process. So that's my overview of a roadmap to buying an online business after buying and selling and helping other people buy and sell well over $100 million in online companies. And I wish you all the best. I think that if you want to buy a company, you just have to jump in and start doing it. The buyers that I see that I've talked to for 2 years that never buy a company, they're just always on the sidelines because they're scared to jump in. They're not prepared. They're not doing what they need to do to be prepared. They're not putting the right people, surrounding themselves with the right people, having the right team for acquisitions, like the right attorneys, the right lenders, the right due diligence partners. So if you want to do it, I'm more than happy to help you and show you everything I know about buying online companies. Just stay tuned. I look forward to putting out some more videos. And if you want a copy of my 12-step business acquisition framework, just click the link below. I'm more than happy to send you a copy of that document to help you and make your acquisition journey as easy as I possibly can.